Hey guys, are you thinking about changing the tax status on your limited liability company? Well, before you do so, you better examine the tax complications that can come from making that type of move and what it'll mean to you down the road. In this video, I'm going to show you what that looks like and how you can go about making a tax change if it makes sense for your limited liability company. All right, let's get started. Okay, so what do I mean by changing the tax status of a limited liability company? Well, here's the thing. Your LLC, it's considered to be a hybrid entity. And that means you can make a tax election to be treated as a C Corp, an S Corp, a partnership, or a disregarded entity for federal tax purposes. And so that typically requires you file the necessary forms to make that type of tax election. Now, there comes a time for certain types of individuals with their companies where they make a determination that the tax election they originally made when they created their LLC just isn't working out for them anymore. Or they want to set up a different type of structure from a tax perspective because they realize, hey, why should I be filing 10 returns when I can reduce that down to 1 and save a little extra money on an annual basis? So whatever your motivation, changing your tax election is possible with a limited liability company, but it has to be done properly. Otherwise, you can risk getting hammered with federal income taxes just by making that one tax change. What am I referring to? Let's go over to the board and I'll show you what we're talking about here. All right, so when it comes to changing your tax election, I'm going to lay out some basic rules here that you need to be aware of to ensure that you aren't going to run into problems. So if I originally set up a limited liability company taxed as either a C or an S Corp for federal tax purposes, and now I decided, hey, this was a wrong tax election for me. Typically, I find this when people have are real estate investors, they own rental real estate in a C Corp or an LLC that is taxed as a C Corp or an S Corp, and they've learned that that's not the best place to be in, and they want to change it to either a partnership or a disregarded entity. So they think it's as simple as just making a change of accounting election, which I'm going to cover at the end of this video on how to do this, making a change of accounting election and turning it into a partnership. Well, if you go from a C or an S Corp to a partnership or a disregarded entity, so if you change the tax status to one of those, then what you're going to face is immediate taxation on any appreciated asset held inside of this company. Meaning this, let's say I owned a piece of real estate in an LLC that was treated as a C or an S for federal tax purposes. And this property has a tax basis right now of $100,000. So that's my tax basis. But it has a fair market value of $250,000. So that means there's $150,000 of gain sitting there that I'm not going to be taxed on until I sell the property. Well, when you make a change of accounting election and we change from a C or an S to a partnership or a disregarded entity, you have to immediately recognize that $150,000. It's essentially treated as a sale when you do that. So when it comes to a C or an S corporation converting to a partnership or disregarded entity, you got to be really careful and get with the CPA to make sure it's not going to create one of these problems for you. Now, can you go from a C to an S? So let's say you originally started out with a C corporation and now you're thinking, well, based upon my business, I could actually be saving a little extra money if I were an S, or you want that flow through treatment. Again, you have to look at the entity itself and determine, all right, what types of assets are held inside of there? What type of business activities is it engaged in? So if I want to go from a C to an S, and let's say it owns rental real estate, investment real estate, well, you can make the selection without any immediate tax ramifications, converting from a C to an S, provided that after you make this election, you convert to the S corporation, this asset right here, you don't do anything with that asset for 10 years. This is called the built-in gains tax that applies when someone's converting from a C corporation to an S corporation. What the Internal Revenue Code is designed to do here with this change of accounting election is they don't want people going from a possible double tax environment into a single tax environment by making this change purely for tax motivated reasons. So the way they combat people from doing that to try to reduce their taxes from a C to an S on, let's say, an asset disposition, is they state that if you hold on to that property, or if you do something with that property, move it out of the company within 10 years, then or sell it, then you're going to have double taxation essentially on that. However, if you hold it for 10 years, then it will get that true S corporation tax treatment. So the greatest concern, again, for real estate investors, from a C to an S, you got to make sure you hold these assets for 10 years. Now, on the flip side, if you wanted to go from an S corporation to a C corp, that's not an issue. You're not going to have any problem going from an S corp over to a C corp. That won't be a problem for you. All right, so that brings me to the next one. How about if we are a partnership and we want to change this to a disregarded entity? So now, what do I mean by that? Well, here's what comes up a lot with real estate investors in my experience. Let me get this screen transferred over here. Let's assume that you have some LLCs that you've set up, right? And they hold real estate. Maybe you have three of these things, three of these LLCs that you've created, each of them owning property. And you and your spouse are members of these limited liability companies. So boom, boom, 50-50, like this, 50-50. So each of those LLCs are set up originally to be taxed as partnerships. So each of them are filing tax returns on an annual basis. So you're filing 3 tax returns. Now, you want to reduce your ongoing costs. You don't want to have such a complicated 1040 with all of the K1s on there. And you're considering setting up a holding LLC at the same time. So you're thinking, all right, I'm going to take myself out of this picture here. I don't want to be the members of these LLCs any longer. What I want to do is this. I want to create a Wyoming holding company, Wyoming LLC, and then my wife and I will be the members of the Wyoming holding company. And then the Wyoming holding company is going to own our interest in these different real estate LLCs. Now, because the LLCs have only one owner, we can change the tax status from partnership to disregarded entities here. So in order to be a disregarded LLC, you have to have only one owner, or you can have a husband and wife own the LLC together, but they have to reside in the community property state. So in this example, the reason I'm moving to the disregarded status is that there's only one owner now, this Wyoming LLC, in these various property LLCs. And what we've done by structuring it this way is we want to eliminate these 3 returns. Maybe we're going to have this one treated as a partnership. So I have ongoing savings and not having to file as many tax returns. So when you make this selection, you make this change to go from a partnership to a disregarded entity. This is the reason why. There are no negative tax ramifications for you to make this change. It's very simple to do. I'm going to show you that in just a minute on how to do that. So that's a reason why someone may go from a partnership to a disregarded entity, because they're restructuring their overall business activities. Now, the last thing, if you want to go from a disregarded entity, say you started out with a limited liability company here initially, and I was the only owner in it. So this would be a situation where I'm the only owner in the LLC, but then I want to bring on a partner into my limited liability company. Once I bring on my partner, this entity would go from a disregarded status to a partnership tax status, because you now have 2 owners and you can no longer be a disregarded entity here. So again, making that type of change, that's not going to create any negative tax implications for you like you have when you move from an S to a C, or C to an S, or C or S to partnership disregarded. All right, so how do you make this election? How do you change your tax status if it makes sense for you to do this? Okay, so what you have to do is you have to file Form 8832, which is a change of accounting election. All right, and so this form has to be filed within 75 days of the end of your taxable year. So if my taxable year runs from January 1st to December 31st, because my entity is treated as a disregarded entity, a partnership, or an S corporation, then by 75 days into the new year, I need to file this 8832 electing to be treated as a different type of entity. So partnership, C Corp, S Corp. And if you choose to be an S Corp, then on top of that, you also need to file Form 2553 to make your S election. Now, if you had a C Corp and you're looking to transfer to an S Corporation, because remember, going to partnership disregarded can be a bad thing. If you're looking to go from a C to an S, then again, 75 days from the end of your taxable year. So if the end of your taxable year is in September, well, just do the math and figure out when that date falls. So you got to get that election made within those 75 days. Now, there are situations where people forget to make the election. So if you don't make the proper election, you can file for late relief. Now, this only applies in your first year before you file a tax return. So assuming I set up an entity in February of this year, and the default classification for the entity I set up, the LLC, was partnership, but I intended for it to be treated as a C corporation or an S corporation, and I didn't make the proper election, the 8832, didn't file it to treat my entity as that corporation, well, you can still make the election. Okay, even though it's beyond the 75 days, what you have to do is you file the 8832. So long as you've not yet filed a tax return for that entity, you file the 8832, and then you put a statement, attach a statement to it stating why it was a hardship, why you forgot to make the filing. Typically you put in there that you didn't understand that this needed to be done and that you intended to treat the entity as a corporation the entire time. You swear under penalties of perjury, this is why you did it and this is what you wanted to be. You send that in and you put under there under the certain RevProc that allows this. You can look this up, you can Google on the internet how to do this, and you can make that tax election change, late relief, if you miss the 75 days. So there are ways to do it if you want to change the tax election on your limited liability company. The best way to do it, of course, is always within the first 75 days after the end of your taxable year. Be aware of it. Always seek the advice of a CPA or a knowledgeable tax professional before you go about making this type of tax change. Hey guys, if you want to learn more about taxes, I invite you to our Tax and Asset Protection live event. It's a free event where we cover everything real estate related when it comes to tax savings and also asset protection. I got a link in the show notes. If you haven't attended yet, this is your opportunity to join me and my team of attorneys and tax strategists as we cover everything about real estate investing from a tax and asset protection standpoint. Look forward to seeing you there.